Let's welcome in our next guest, Ashok Kumar, promoter of LKW Investment Advisor. Mr. Kumar, thank you so much for taking out time for us. You've always been known for allocation of wealth and how one should look. 2017, of course, is a new year. People would want to, go ahead and start their allocation even if they have not earlier. Can you just first tell us that in 2017, where do you expect returns to be made, debt and equity, or a mix of both?
Yeah. Thanks, Pankaj. At the outset, I think the first thing that is to be noted is when we talk of a year in terms of investing, and especially when we're talking of investing in equity, when you say it's a great year, there could be two things. It could be a great year in terms of returns. It could be a great year in terms of investing. My hunch is that there's going to be a great year in terms of investing. Returns would depend on way too many. I think there are way too many intangible factors at this point in time to gauge where the returns would be. But someone who's going through a SIP or an STP and accumulating a lot during the year, I think the rewards will come sooner rather than later. As far as allocation goes, it's always a good idea to have a mix of multiple asset classes. Never a good idea to put all your eggs in one basket.
Right. As far as a debt or a mix of debt and equity is concerned, because of the recent volatility that we have seen, probably because of demonetization, other physical asset classes, may not be that attractive. That doesn't change much in terms of allocation strategy towards equity?
Yeah, so again, I mean, within, when we do wealth management, what we do is that we demarcate. You have a strategic asset allocation which should remain more or less intact. It shouldn't significantly change based on market conditions. But the dynamic asset allocation, which we would say about 1/3 or maybe 25 to 30% of the portfolio, there you would make the changes. And I think at this time you see a lot of money gravitating.
Mr. Kumar, just if you could for our viewers tell what dynamic asset allocation is, because a lot of them may not be aware about it.
Okay, so strategic asset allocation is the asset allocation that you start with. You're looking at it from a long-term time frame, 10 to 15 years perhaps. The dynamic asset allocation is what you would look at for a 15 to 18-month period. Given the kind of market volatility that is expected, I think there's a lot of gravitation towards hybrid funds, which are a mix, inbuilt mix of equity and debt. So hybrid funds, you could look at multiple hybrid funds. You could look at a balanced fund. You could look at a MIP at the lower end of the spectrum. There are also dynamic asset allocation funds, which, you're sort of handing over the asset allocation to the fund manager who would do it for you.
Right. As far as, the view into equity is concerned, earlier the view was, you should invest or make any SIP, make any STP or dynamic allocation based on a 3 to 5 year view. That continues to be the case, irrespective of market declining in the last 45 days?
Yeah, absolutely. The investments, any investments in equity, be it direct equity or through mutual fund route, which is what the retail investor should prefer, according to me, has to be with, I would say, a 5 to 7 year horizon, because typically economic cycles play out over 5 to 7 years. And there is going to be, invariably there is one upside in that 5 to 7 year period, which pulls up the averages a lot. So that's where you actually make the money. It's a game of patience. It's a game of, playing the waiting game with the right selection. Selection, of course, plays some part. You need to select the right funds from the right segments to actually optimize your portfolio.
Right. Also, one thing that I have noticed is that for equity inflows, it was always a function of returns and returns followed by flow. But 2016, or even if you look at 18 months, it was not a great year for returns. But flows have actually increased or remained stable. Is that something which is telling you that the way the flows were coming into the system has changed?
Excellent observation, Pankaj, and that is exactly. I think the silver lining in 2016 was really that you're seeing a gradual shift. I would tend to think that if you look at the profile of the investor, you would find a much younger investor that is participating in this market. SIPs and STPs have become popular, SIPs especially among younger investors. So the fund flows are steady. And if you look at the kind of FI outflows we witnessed, a lot of it was buffered by the domestic inflows. So all in all, a very good situation. Some of its root lies in various investor programs that have been conducted for the last 5 to 6 years, where young people have been briefed on how to make investments in the market. So contrast that with, say, my time 20 years ago, when people would make a lump sum investment, take a beating in the market, and then sort of look at their forehead and say the markets are not for me. But today you have investors who are a lot smarter, better advised, and we have a much more organized setup, which is why you're seeing gradual flows into the market, and these are very steady flows. I don't see them disappearing in a long while.
Right. And what does this mean? It's still a very small portion of FIIs, so they can support the market if there is an unforeseen event?
Yes, unforeseen event, that you would see correction, but what I'm saying is that the flows will not disappear, which means that there would be a certain amount of support that is going into this market.
Okay. Let me just change my question. What I meant to ask is that whenever markets go down, retail investors just go away from the market, right? And when the market starts to go up, they tend to come up. Absolutely. But with this sort of a flow, when a fund manager is given money, an active fund manager, he's into a position to know probably what to sell in the portfolio and what to add at that price. Do you think that will reduce the burn rate, which means the flows will be sustainable?
Absolutely. The flows are definitely going to be sustainable. My hunch is that they will grow from here, because I think investors have got a lot smarter. The younger investors know that when the market falls, you actually top up. So we are seeing a lot of that, across the board. So typical strategy has been SIP. You also have a STP flowing, and given the micro and macro conditions, you would have several scenarios where the markets take a dip. There are top-ups that happen at that time. So the inflows are not going to be affected. External factors, will play out as they do.
Right. What funds would you recommend, people if they have not done a fresh start, and what should be essentially the allocation towards mid-cap, large cap, and probably debt, and then you could go into specific funds?
Yeah, so very quickly, if we look at the life cycle stages that are there for an investor, a young investor who's in the wealth creation stage, let's say 25 to 40, is really looking at mid-cap and multi-cap funds. Middle stage investor who's consolidating would be looking at hybrid funds with a bias towards equity, which means balanced funds and maybe some MIPs. Then you have the final stage, which is the protection stage. Post 55, you want to protect your wealth. You don't want to destroy any of the wealth that you've created over and consolidated over a period of time. So you would have equity predominantly, that is mid-cap and multi-cap in the first stage. You would have balanced in the second stage, and you would probably have pure debt in the third stage.
Right. And which would be the specific funds that you have identified?
Some of the funds on our radar, and they're not necessarily, the only recommendations, but given the paucity of time, some of the funds that we have on our radar are, in the mid-cap category, L&T Value, which has been an excellent value fund. They pick up the anomalies of valuations pretty well, is what we have observed. Their track record has been fairly good. In the multi-cap category, you have the Kotak Select Focus, which is again a sector-heavy fund. They look at a sector and then do a top-down investment. In the third category, which is the balanced fund category, which at the moment is probably the hottest category. A lot of money in India is gravitating towards this, category. You have the ICICI Balanced Fund, which has been an excellent performer over a long period of time. They take long-term exposures to stocks, and even with their debt component, they have AA rated paper. So all in all, it's been a good bet, and if you look at the numbers, they are fairly impressive.
Right. Just talking about these three funds which are on the screen. Balanced funds over a long-term period would give similar returns to equity, or marginally here and there?
No, that's again, most of our studies have shown that if you look at 1, 3, 5 years, and it's been a good market, equity outperforms balanced funds quite comfortably. On the downside, the balanced funds obviously have an inbuilt cushion of the debt, so they don't go down as fast. But if you look at a long time frame, as you asked, about 10 to 15 years, you'll find the balanced fund, there's a very marginal difference between the two, which makes me a strong advocate for balanced funds.
Right. And can you go ahead with the two debt funds as well?
Yeah, one is a debt fund and one is a tax-saving fund. Of course, being this season, the last quarter of the financial year, the Birla Sun Life 2 or Wealth 25 is a MIP. Now, they have a fair equity component, which is 25 to 30%. But they invest in AAA rated papers, and they know a trick or two. If you look at their long-term track record, they managed both debt and equity pretty well. So this is again for a early stage protection investor. Someone looking for protection over a longer period of time would go in for absolute safety. It could be a liquid plus and that kind of fund. The tax-saving fund that we are talking about, since this is the season, is the Franklin Tax Shield. Amazing track record over 25 years, good dividend history, and an excellent track record. Agnostic style of investing. They look at bottom-up style of investing. So each one of these funds are on our radar, and they're pretty impressive track records for each of these funds.
Right. Just a word in terms of somebody making a fresh start. All these 5 funds with equal allocation could be done?
Never equal allocation, Pankaj. That's a very simple way out. I think tax savings, of course, used for a specific purpose. The other four funds, yes, I mean, depending on which category you're in, if you're in the wealth creation stage, the first two funds that I spoke about should be reasonable. If you're in the consolidation, which is the middle stage, the balance fund would do you good. And if you're in the early part of the protection stage, you're looking at an MIP.
Right. Mr. Kumar, thank you so much for taking out time for us. Always good to get in a perspective.